now that we can talk about and use those cost flow methods a little bit, we can look at the financial statement and the tax effects of cost flow methods. So there's a consequence to choosing different methods for figuring out your inventory and your cost of goods sold. So we'll get into study objective 3 now. Keep in mind, remember, you can always click into this review animation and a narrator will go through a bunch of slides telling you all about the key points in these chapters. So the financial statement and tax effects are kind of going to be found through here. I'm going to let you read a lot of this stuff without a lot of commentary on my part. Using different methods will produce different ending inventory and different net income results because cost of goods sold will be different under each of the three methods. You keep in mind that, like under LIFO, that uses the latest costs going to cost of goods sold. So the latest in periods of rising prices, that usually means the higher costs go into cost of goods sold. So LIFO produces typically a higher cost of goods sold, which is an expense, so a lower net income. And that can be important if managers are really concerned about the representation on the financial statements of their income figures. From a balance sheet perspective, which method is going to give you the highest inventory, which method is going to give you the lowest inventory. Those things are relevant to consider too sometimes. So you can read about that. Tax effects, which method is best for income taxes, which causes the lowest taxes. So you can read about that. You have to be consistent unless you apply for a change in method. Study objective 4 talks about the lower of cost or market. There's a rule in GAAP that says you've got to, if your inventory value drops below the cost of the inventory you've got recorded, you have to adjust your inventory balance down to an amount that reflects that actual value. So study objective 4 talks about that, and I'll let you read about that. You do it on a inventory item by inventory item basis. You can see for these inventory items, these are the cost amounts, this is the market value. So the lower of cost or market method would have you take the lower of these two numbers and report it in inventory. So then this total inventory balance would be what shows up on the balance sheet.